Okay, hello. I'm back again. This is Sunko. Okay, let's get back to where I left off. I was reading an article about the fact that it's not fact, but like the article about the bull market, and it says the bull market is coming, and it says that rarely do we have any two consecutive years of bear market. So he says that we'll have a bull market this year, and we'll see. And with this optimism of hoping for a bull market in mind, buying this stock could be a genius move for your portfolio. So get ready for a bull market, and if you buy these stocks, then you'd get filthy rich. It's his point, right? And the first one is Netflix. Okay, if a bull market does happen in the near future, investors are going to want to own growth stocks as they tend to bounce back quickly when asset prices start rising again. However, if there is a one key lesson that everyone should have learned from 2022, it's that profits and free cash flow matter tremendously. Free cash flow. Free cash flow means while many fast growing businesses relied heavily on access to cheap capital for most of the past decade, the economy is now in a new normal of higher interest rates. As a result, investors should prioritize companies that don't need to raise external cash and that have strong balance sheets. That have strong balance sheets, okay? Yeah, let's see Netflix. Let's go to Yahoo Finance. Mm, let's go to balance sheet. Okay. 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 Netflix is a prime example of enterprise that perfectly fits this description. Toward the end of 2021, management made the announcement Netflix would no longer need to raise additional debt to fund its operations, which turned out to be perfect timing as the Federal Reserve started aggressively hiking interest rates in 2022. As of September 30, the company had $14 billion of gross debt on its books within management's range. Hmm. Okay. So as of 2022, they no longer need to raise additional debts. They no longer need to raise additional debts, okay, to fund its operations. Instead, as of September 30, they had $14 billion of gross debt on its books within management's range. Okay. Within management's range, okay. Mm. According to the leadership team, the top streaming service is projected as having added 4.5 million net new members the last 3 months of 2022. And annual revenue is forecast to come at $31.5 billion, good for 6% increase versus the prior year. Investors will know for sure when Netflix reports earnings next week on January 19. Hmm. Over the next 5 years, Wall Street consensus analyst estimate call for sales to increase at an average yearly rate of a 10.2% between 2022 and 2026, with earnings per share rising at an even faster clip of 19%. What's more, Netflix is expected to have generated slightly positive free cash flow in 2022. Free cash flow. Okay. Free cash flow. Free cash flow. Free cash flow. Okay. Um Wall Street consensus as estimated call for sales should increase at average yearly rate of 10.2% between 2022 and 2026. Call for sales to increase, with earnings per share rising at an even faster clip of 19%. What's more, Netflix is expected to have generated slightly positive free cash flow in 2022, a major accomplishment for a business that many thought would never reach this point. And starting in 2023, there could be substantial growth with this financial metric. That's exactly what investors should be looking for now. Netflix shares are up about 91% over the past 6 months, a clear indicator that investor sentiment has now turned positive in the stock. The first 2 quarters of 2022, Netflix lost a calm at 1.2 million subscribers, a first for the company, and this helped drive shares sharply lower. At one point last year, the stock was down a whopping 72% from its all-time high set in November 2021. It looked like the best days for the streaming pioneer were a thing of the past. But as is always the case with the markets, investors can become overly optimistic in good times, pushing up shares prices to irrational levels. When there's a bit of bad news about a particular company, these same investors ignite a sell-off that is far worse than the fundamentals would suggest. Based on its recent stock performance, I think we're seeing this play out with Netflix. Yeah, I totally agree with this. As soon as bad news comes out, a lot of investors they just go along with the sell-off trend, and it goes down to level uh, far lower than uh, the fundamental would suggest, right? Let's repeat this one more time. It's a really important paragraph. As is always the case with the market, investors can become overly optimistic in good times, pushing up shares prices to irrational levels. And when there is any bit of bad news about a particular company, these same investors ignite a sell-off that is far worse than the fundamentals would suggest. Based on its recent stock performance, I think we're seeing this play out with Netflix. Netflix still a leading global media and entertainment business with solid growth prospects and a stronger financial position. Mm. Plus, investors have the opportunity today to buy the stock at a compelling price to earnings ratio of 30, which is well below its trailing 5 years average. That's an attractive setup should a bull market take over the market this year. Mm. Better buy Nvidia versus Taiwan Semiconductor stock. Nvidia isn't just about gaming anymore. Taiwan Semi is the safest bet in the chip industry. Both stocks could be worth buying now. Okay. Nvidia and Taiwan Semiconductor Manufacturing are two industry leading companies at the forefront of the chip industry. But both stocks are down over 40% from their all time highs due to a downturn in the industry. There's why each company may be worth a look now. A bet on the future, Howard Smith. There's no doubt that Nvidia stock was given too much of a premium valuation based on the growth investors expected. So, good news comes out, and people are like overly optimistic. Um, if new good news comes out, right, and like it gets overly priced at some point. That's how the stock market goes. That helps explain the more than 50% drop from its highs in late 2021. They became especially clear when revenue growth in its largest segment sharply reversed course in the current fiscal year. But the promise and potential that drove Nvidia shares to its unsustainable valuation weren't about the gaming segment, which was thriving at the time. And the transition has already begun that will see the data center, automotive, and artificial intelligence segment driving the company. Gaming, data center, Nvidia quarterly segment revenue, auto, Omniverse, data center takes up most of the position. While revenue from a gaming chips was only half of what it was a year ago, Nvidia's data center business grew 31% year over year in the fiscal 2023 third quarter period ended October 30, 2022. An investment in Nvidia now is a bet on growing contributions from automotive and AI customers. Investment in Nvidia now is a bet on growing contributions from automotive and AI customers who have increasing needs in autonomy, robotics, and data analysis. And though Nvidia's dividends is minuscule compared to that of a Taiwan Semi, the company has returned $9.3 billion to shareholders in the form of share repurchases over the first 9 months of fiscal 2023. That represented just over half of what has been authorized for buybacks through December 2023. Nvidia and Taiwan Semi may not deserve the same share of a portfolio. I bet Nvidia carries added risk that industries like autonomous vehicles and AI will mature and thrive. But for those willing to include a speculative investment with a lot of potential long-term upside, Nvidia's share price correction is now providing an opportunity. So if you are like a long-term investor, you would it's better for you to invest into Nvidia. But like for Nvidia to gain profit, it's gonna take some time because what they are delved into are like industries such as autonomous vehicles and AI, which are something that takes some time to mm, invest to mm, investigate. So, and Taiwan Semi is a layup for the long-term growth. Okay, let's see. Few companies hold a candle to Nvidia. When it comes to dazzling growth and glamorous products, but what Taiwan Semi lacks in flair is more than makes up for it with a lower valuation, wider moat, and a higher dividend yield. Taiwan Semi has a dirt cheap forward price earnings ratio of just 13.4, a dividend yield of 2.3%, and a 47% operating margin, beating Nvidia in all three categories. So let's repeat this one more time. Has a dirt cheap forward price earnings ratio of just 13.4, a dividend yield of 2.3%, and a 47% operating margin. Okay. NVIDIA is one of the most innovative companies in the semiconductor industry, but it's a far riskier business model than Taiwan Semi. It's a okay. NVIDIA is a far riskier business model than Taiwan TSMC. Okay, Taiwan Semi is the world's largest pure play chip foundry. You may be surprised to learn that a fabless chipmaker like NVIDIA doesn't actually make its own chips. Much like Apple isn't actually making its iPhones, it relies on suppliers for that stuff. Like, okay, NVIDIA don't make their own chips. Like Apple don't make their own iPhones. They um they rely on suppliers. So uh NVIDIA relies on suppliers, just like Apple. NVIDIA, like basically every major player in the game, relies on Taiwan Semi to make a sizable chunk of its products. Okay, NVIDIA relies on TSMC. So TSMC is like a uh, they can do whatever they want. So Taiwan Semi isn't really a competitor with Nvidia. In fact, Nvidia is one of its main customers. Uh, Instead, Taiwan Semi is competing with other chip foundries. The name of the game is providing services for the changing needs of customers at a low cost and a fast turnaround. Taiwan Semi isn't immune to competition, but no company comes close to its size and efficiency. Mm. In this vein, Taiwan Semi is a far safer bet on the growth of the industry than any other chip maker. With Taiwan Semi, you are investing in the growth of chip production and usage. Whereas with NVIDIA, you are investing in a company you think will spearhead technological breakthroughs. Okay. So it's like a Taiwan Semi is like more safer bets because they you're investing in growth of chip production and usage. Whereas if you invest in this Nvidia, you're like spending your money on technological breakthroughs. Okay. For comparison, investing in stocks like Home Depot is a way to indirectly bet on the housing market instead of investing directly in a home builder. Or investing in a Caterpillar is a good way to bet on construction, oil and gas. Okay. Nvidia stock could outperform Taiwan Semi if it continues to out innovate its competitors, but that is a relatively riskier proposition than just going with Taiwan Semi, which has a far better risk reward profile than Nvidia. Okay, two good options worth considering. NVIDIA and Taiwan Semi operate on different sides of the semiconductor industry. NVIDIA has done a masterful job of diversifying its business to include gaming, data center, AI, autonomous vehicles, gaming, data center, AI, autonomous vehicles. But for now, the AI autonomous vehicle side of its business remains a size show, while data center and gaming performance are highly cyclical. That being said, Nvidia is positioned to outlast downturns while still being able to invest in multi-decade trends. Meanwhile, Taiwan Semi is poised to continue outspending its competitors to retain its industry-leading manufacturing profile. As the industry evolves and becomes more complex, Taiwan Semi has the margins and cash flow necessary to make necessary improvements. Aside from being different companies, both stocks have a contrasting investment thesis. Nvidia offers arguably more upside with its potential to be a leader in industries that could unlock untold value, but it's also a more expensive stock that lacks a meaningful dividend yield. By contrast, Taiwan Semi should enjoy steady growth in lockstep with the overall industry. So there's like a big comparison between Nvidia and TSMC. Nvidia is more like focusing on gaming, data center, AI, automotive, and AI are like more sideshow, but like they're gaining a lot of profit from a data center. So they're more like focused on a technological perspective, but like TSMC, they're gaining profits steadily. They're really stable in terms of mm, uh, taking a position of a industry leading role. Mm. So it's more safer bet. Like TSMC, is more safer bet. Nvidia is a riskier bet. Okay. Mm. One of the smartest dividend stocks to buy with $1,000 in 2023. Let's see what that is. Waste management. Okay. Oh, it's interesting. Let's see. If you're looking for a place to pour cash, this dividend stock looks like a great spot. Okay. The past year persuaded many investors to find businesses with less risk than the tech stocks that thrived in 2020. If you are in the market for a stable company that rewards shareholders with impressive dividends and minimal volatility, if you are in the market for a stable company that rewards shareholders with impressive dividends and minimal volatility, then waste management could be for you. Here's why WM, so called, as the company likes to be called now, could be one of the best dividend stocks to own for a long hour. This enduring dividend, okay, this one is really something that I should look into. Um, Waste management, right? This enduring dividend. WM stable business of trash collection, transportation, and recycling has led to a long history of shareholder-friendly actions for investors. The company's recently announced 7.7% dividend boost brings the payout to $2.80 per share annually, deciding to state a dividend hike, but that is nothing new. In fact, this was WM's 20th consecutive annual dividend increase. When WM started offering dividend in 2003, the payout was just 0.01 per year. And over the past decade, the company's annual payout has nearly doubled. Okay. With 20 consecutive years of dividend growth, WM is gradually on its way to becoming a dividend king, a company that has raised its dividend for 50 straight years. This is an exclusive list with only 48 stocks qualifying currently. WM still has another 30 years to go, but the company's dividend could thrive for the next 3 decades. Let's find out why. It's built to last. WM is the dominant force in the North American solid waste collection and recycling market with a 24% market share. Okay. This outpaces every other independent rival when WM will likely keep its top dog status for the long hour. Why? Simply put, it would be immensely accomplished for even the established rivals to reach WM scale. The company has over 260 active landfills, collection trucks. They cover 15,500 routes across the US and Canada, 445 facilities. They convert landfill gas to energy, 550 collection sites. Lots of their infrastructure. Accumulating this much equipment would be time consuming, logistically challenging, and downright expensive for all of WM's competitors. So they're like a major player in this industry. Mm. No rivals can compete against the waste management um because they got a lot of facilities, a lot of infrastructure that takes so much time for its rivals to get ready, right? Just because WMA has sustainable leadership role doesn't mean isn't continuing to invest to ensure it stays on top. WM continuously invests money into capital expenditures and purchases of smaller business to enhance and expand its network. So it's not only um it not only stays where they are, but like they're expanding by having you know merge and acquisition stuff like that. From 2019 to 2021, WM spent roughly $10 billion on reinvestments and acquisitions to maintain its leadership in the space. Okay, reinvestment acquisition to maintain its space. These investments have a history of being far more efficient than the investments by WM's rivals too. WM's 5-year median return on invested capital has been nearly 9.6%, while Republic Services, second player in the industry, had a median ROIC of just 6.6% over the same period. Its dividend isn't the only one reason to get excited. While the company's sustainable and likely ever-growing dividend is one reason to like WM, ever-growing dividend, and sustainable ever-growing dividend. The company rewards shareholders in other ways too. Okay. The first method is share buybacks. In the first 9 months of 2022, for example, WM spent over $1 billion buying back stock. That's more than he spent paying out its seizable dividend. Hmm. Considering that the company's number of outstanding shares has contracted by 12% over the past decade, these buybacks seem to quite effective. The second reward comes in outstanding stock price performance. Over the past 5, 3, 5, and 10 years, shares of WM has outperformed both the S&P 500 index and Dow Jones Industrial Average. Mm. Despite beating the indexes, WM can also provide for less volatility. This was made abundantly clear over the past year as shares of WM dropped just 1.6%, handily beating the Dow and the S&P 500, which fell 6.3%, and 15.8% respectively over the same period. WM looks like the perfect combination of healthy stock price returns, low volatility, and exceptional shareholder friendly actions. This castle has seemingly unbreachable moats, which could mean that these trends could continue for the foreseeable future. So, if you're looking for stability or steady income stream for a long out, this dividend stock could be for you. Hmm. Okay, today, the one company that I feel like I feel good because I found a company that I would love to invest. Hmm. Market Berry is bearish on stocks again. Here's why. Market Berry and other stock market bears have previously made accurate predictions regarding asset bubbles. The S&P 500 could have entered a new downtrend, while other economic indicators are also flashing danger signs. China's recovery may be pivotal to avoiding a global economic disaster, but the housing market could be what ends things. Hmm. Hmm. Anyway. Okay, let's get back to Yahoo Finance. First, what I'm going to look at is uh Roblox. Roblox. Let's look at Roblox. What company owns Roblox? Okay. Roblox is an American video game developer based in San Mateo, California, founded in 2004 by David Bisky and Eric Hassel. The company is the developer of Roblox, which was released in 2006. Okay, blah blah blah. Okay. Google company Roblox is an online game platform and game creation system developed by Roblox Corporation that allows users to program games and play games created by other users. Is Roblox a billionaire? Is Roblox the richest gaming company? How Roblox became one of gaming's hottest companies. Okay, let's look at this one. Oh, it's an online gaming company with no history of blockbuster titles and whose biggest market is preteens. Yet after its IPO in mid-March, the company's value suppressed industry stalwart Electronic Arts. So what's the secret to its success? Okay, what's the secret behind their success? Roblox allows users to make their own games and let players play mm, games made by users. Oh, let's see. If you don't have kids, there's a good chance you've never heard of Roblox, a free online gaming platform that's known for its Lego-like graphics. But if you're an investor, you're probably paying attention now. Roblox Corporation, founded in 2004, went public on March 10, listing shares on the New York Stock Exchange at an opening price of $64.50, translating to a valuation of $42 billion. That represented a more than tenfold increase in the company's worth since the funding round in February 2020 and catapulted is ahead of some of the industry's biggest names like Electronic Arts, known for sports titles like FIFA, and Take Two Interactive, which controls Grand Theft Auto. Not bad for a company with no history of blockbusters titles, whose biggest market segments preteens. The Reach valuation reflected both Roblox's business model. The Reach valuation reflected both Roblox's business model, which focuses as much on entertainment as it does on creating an immersive social experience, and the market for online gaming. In a nutshell, the industry is scorching hot with the COVID-19 pandemic accelerating growth just that has fueled the digital transformation of the global economy. Strong tailwinds. Okay, let's see. Video gaming has a lot of strong headwinds, says Jimmy Stone, a finance expert in the Top Tool Network since 2018 and managing partner at a financial consulting firm. Not a lot of industries are large or growing that quickly, and it checks a lot of the investment and theme boxes from the pandemic. The expansion of mobile connectivity and proliferation of free to play games have been driving the growth of the industry for more than a decade, mm, making it bigger than movies and music combined. According to Stone, with schools and offices shuttered last year to limit the spread of the virus, spending on games globally, including mobile and consoles, shot up about 20% compared to 2019, according to games market data company Newzoo, putting it on pace to reach $280 million by 2023. Investors have taken notice. One popular market proxy, the Vanica Vectors video gaming and esports ETF returned about 95% in the year ended February 2028. That compares with a gain over the same time period of about 57% for tech heavy Nasdaq 100, which reflects a broader cross section of companies that benefited from the pandemic's dislocations. Hmm. Roblox probably dead. Also, uh, Revenue, which is driven by small purchases known as microtransactions that players make during the game, surged 82% to $924 million. The company's forecasting continued revenue growth in 2021, albeit at a slightly lower pace of about 60% year over year. Its, its net loss also surged over the same period, as it tried to keep up with the growth, reaching $253 million, though they did little to scare investors. It's not just a video game company, and it's not a studio, it's a platform. A former analyst at the Global Hedge Fund and a top two finance expert since 2017, they're very well positioned for growth going forward. Gaming has always been about fresh titles and the latest graphics, but the industry today is as much focused on the social aspect of its products. People don't just play games together online. In a survey conducted last year, the polling and research company Nielsen found that roughly 1 in 4 U.S. residents were using video games to stay in touch with family and friends, a phenomenon made possible in part by the proliferation and popularity of multiplayer games. So the game, people are not using play game just for fun. They're using it for, uh, they're not just focused on the game itself. They're more like playing games for interacting with people. They use games uh, for socializing. So from social purpose, uh, they play games. Hmm. Nielsen also found in its survey that even though people were more sedentary last year, they were spending even more time on mobile games, which saw usage grow faster than on consoles like Sony's PlayStation and Microsoft's Xbox, as well as personal computers. They can be seen as another plus for a device agnostic company like Roblox that stayed out of the hardware business and derives more than half its revenue from microtransactions made through its mobile game version. Mm. Behold the metaverse. From its founding, Roblox has envisioned an immersive social community for its players. It calls the metaverse. Okay. Hmm. Hmm. Okay, Roblox is not just game. They let people um let people having some they let people have some social gathering. Hmm. A survey that even though people were more sedentary last year, they were spending even more time on mobile games. Okay. Which saw usage grow faster than on consoles like Sony's PlayStation and Microsoft's Xbox, as well as personal computers. It can be seen as another plus for a device agnostic company like Roblox that has stayed out of the hardware business and drives more than half its revenue from microtransactions made through its mobile game version. So their mobile game version, they're not using a hardware console because they think that mobile is the device that people would use more often, um, not a hardware thing. Behold the metaverse. Okay. From its founding, Roblox has envisioned an immersive social community for its players. It calls metaverse. The metaverse, like the one depicted in the 2018 movie Ready Player One. Just like in the film, Roblox users exist as avatars on the platform and can traverse the millions of game experiences available using the same identity, or they can partake in virtual gatherings. Like in November, when rapper Lil Nas X was transformed Roblox graphics on the platform, where he performed a concert, an event that attracted more than 33 million views. The platform has also always made it easy for people to develop their own games, offering a series of simple steps in addition to more sophisticated development, which is one of the reasons more than half of Roblox users are under the age of 13. It's also why there are literally millions of games on the platform. Roblox made it fun for kids to make them. So the main secret behind Roblox is that it's like a metaverse. Uh, they even held a concert and it attracted a lot of viewers. And they let players make their own games, so it attracts a lot of kids. Kids are creative and kids love to make games, right? That's also a competitive advantage since the company doesn't have to invest in developing new titles. Users in the platform do it for them, says Alfman. So like company don't have to really think about what games they have to make for next version. Like users make their own games and users let other players play games. So they don't have to worry about it. To choose the to close the To close the top loop on the self-contained platform, the company uses its own currency called Robux, which must be purchased to make microtransactions, which are often made in game for things like avatar enhancements. The company similarly allows developers to keep the majority of Robux they generate, which can be converted to cash, creating an economy of tiny capitalists. More than 1,000 developers earned more than $10,000 in Robux last year for their work. The company said in the filing before the stock listing. One of the biggest challenges Roblox faces going forward is that in order to keep evolving, it must monetize more of its economy, incentivizing even more successful game developers in its metaverse as it competes with companies like Unity's technologies that also offer end-to-end software development for game makers. Another is its popularity with children, which means it must be particularly zealous in ensuring its site is a safe space. In the meantime, there's still plenty of growth to be had. 2 years ago, Roblox formed a strategy partnership with Tencent, the China-based company that is the largest video game publisher in the world, giving the San Mateo, California-based company access to one of the world's largest online gaming markets. Hmm. Okay, he gets it. Social play. So, okay, Roblox being one of the gaming's hottest company because it's a social game. It's not just game; it's a social game. Hmm. Social play. Oh. Okay, I'm gonna have to get back tomorrow or the day after tomorrow and read more about Roblox and the secret behind their success. Okay. Anyway, this is it for today. I'm gonna see you tomorrow. Okay. Bye bye.